Usually when we talk about banking, it operates a bit like an X-ray machine. I mean,
Yeah.
it's a strictly binary read. You walk into a building with these marble floors, you hand over a stack of paperwork just filled with jargon, and the institution essentially looks at your financial skeleton.
Yeah, your credit score, standard income, all that.
Exactly, your liquid assets, and you either have the exact bone structure their algorithms require, or you're just denied service. It's a system built entirely around rigid conformity and, well, the convenience of the institution itself.
Which leaves out a massive percentage of the global population.
Yeah.
Because when a financial system requires your life to fit neatly into rows and columns on a spreadsheet, anyone whose economic realities, say, seasonal or communal or tied to physical goods, they get completely locked out. Traditional banking demands that you adapt to the bank rather than the bank adapting to you.
But what if that rigid binary X-ray machine was just thrown completely out the window?
That'd be nice.
Right. Imagine for a second walking into your local branch, bypassing the ATM, and depositing a live cow.
A literal cow.
A literal breathing cow. Or imagine sitting down with a loan officer and asking for capital specifically to pay for your cousin's wedding and having them actually say yes.
Which sounds crazy to most of us.
It really does. Or, and this is the mechanism that I think really challenges our basic assumptions. What if your bank actively shared the financial loss if your small business went under?
Right. It sounds chaotic, especially to anyone trained in owner finance.
Yeah.
It sounds like a recipe for a localized economic collapse, honestly. But the reality is quite the opposite. We're looking at an incredibly sophisticated, mathematically sound, and highly regulated system that is operating right now.
Welcome to today's deep dive. We are jumping straight into a document that is radically modernizing grassroots financial inclusion. It proves that finance can be highly localized without sacrificing stability.
Absolutely.
So, our source material today is the Savings and Credit Cooperative Society's Financial Service Provision Directive number 982-2016.
And just for context, that 2016 is in the Ethiopian calendar.
Right, good catch. Which corresponds to the year 2024, for those of you listening.
Yeah.
Issued by the Ethiopian Cooperative Commission under Commissioner Getachew Mlesbele. The physical document actually bears this very distinct, interconnected purple coupe logo.
And that purple logo is actually the perfect visual anchor for what this directive accomplishes.
How so?
Well, it's a blueprint for connection. The whole mission of this directive is to mandate how cooperative societies, which are often referred to as SASCOs, how they provide financial services to communities that traditional banks just ignore entirely.
Right.
It establishes this highly adaptable ecosystem designed to increase financial literacy and promote savings. But, and this is key, it does so strictly on the community's own cultural and economic terms.
So how does a system like this actually get off the ground? Because it has to start with how value is captured in the first place, right?
Yeah.
Which means fundamentally redefining the bank deposit. The directive outlines regular savings, which is like a mandatory baseline contribution to keep the cooperative liquid.
Yeah, that's the foundation.
Right, and that sits alongside voluntary demand savings and children's savings to build generational financial habits.
What?
But the mechanism that really stands out to me is in-kind savings.
Oh, yeah. That's a big one.
The directive explicitly allows members to physically deposit their crop yields or their livestock.
Which is just a brilliant, necessary adaptation to agrarian reality. I mean, think about the friction of traditional banking for a farmer.
It's massive.
Right. If a commercial bank only accepts fiat currency, they're putting up an insurmountable barrier. To save money, a farmer has to transport their livestock to a market, negotiate a sale, secure the physical cash, guard it from theft, and then travel all the way to a bank branch.
That's practically a full-time job just to make a deposit.
It is. But the cooperative cuts out all of that friction. They accept the physical asset, convert it to cash internally, and register that value as the member's savings.
Okay, let's unpack this for a second. It's almost like a financial potluck.
A financial potluck, yeah. I like that.
Instead of needing cold, hard cash to enter the financial system, your harvest is your ticket in. You literally bring home the bacon, and the bank cashes it for you.
They are essentially acting as a localized commodities broker just to facilitate a basic deposit.
Wow.
Yeah, the cooperative takes on the logistical burden of liquidating the asset so the farmer doesn't have to.
So it converts the kinetic energy of a harvest directly into the potential energy of financial savings.
That's a great way to put it.
And speaking of capturing capital, there's another fascinating, highly psychological mechanism they use to build up their reserves, The directive calls it the lottery and savings ratio.
Yes, the lottery system. It's a perfect example of leveraging human behavior for communal stability.
Break that down for us.
Sure. So let's say the cooperative needs to raise a significant amount of capital quickly, maybe to fund seasonal agricultural loans. Instead of just begging for deposits, they announce a lottery as the desirable prize.
Yeah.
But to buy a ticket or to access the benefits of that lottery pool, your locked-in regular savings must meet a specific proportional ratio. The directive mandates this can range from 1 to 3 up to 1 to 7.
Wait, let's do the math on that for the listener. If the cooperative sets a 1 to 7 ratio and you want to participate in a lottery pool valued at, say, 1,000 units of currency, you are required to have 7,000 units safely locked away in your regular savings account.
Precisely.
Wow.
It gamifies the accumulation of wealth, but in a highly defensive way.
Yeah, no kidding.
It leverages the universal human desire for a sudden windfall to enforce disciplined, long-term saving. You can't just gamble your loose change. You have to prove you're an invested, financially stable member of the cooperative to even play.
That's really smart.
And crucially, the directive heavily regulates the cooperative side of this too. They're strictly forbidden from taking the capital raised through these lotteries and sinking it into illiquid long-term investments.
So they can't just gamble with the community's money.
Exactly. The liquidity must remain accessible to protect the safety of the members' regular savings.
Okay, so if a cooperative is taking in physical goods like cows and grain, and they're gamifying deposits through these highly structured lotteries, their capital pool is incredibly unique.
Very much so.
They can't exactly turn around and hand out standard 30-year cash mortgages based on FICO scores.
No, absolutely not.
How on earth do they distribute that value back out into the community? Which I guess brings us to the art of lending and this concept of using the community itself as collateral.
Right. When you remove algorithmic credit scores from the equation, you have to look at what actually holds value in a tight-knit community.
Which is what?
Reputation, social ties, and hyperlocal assets. The directive states that loans should primarily target income-generating sectors, so agriculture, micro-business expansion, and housing construction.
Okay, that part aligns with standard microfinance. You buy seeds, you grow crops, you sell the harvest, you pay back the loan. But the directive explicitly carves out a category for social needs. Under this umbrella, cooperatives are authorized to lend money for medical expenses, education, home furnishings, and weddings.
Yeah. Weddings is always the one that catches people off guard.
Well, here's where it gets really interesting, but I have to push back.
Go for it.
Loaning money for an income-generating farm makes sense, but loaning money for a wedding, isn't that just encouraging bad debt for a giant party?
It absolutely looks like terrible risk management from a purely Western capitalist viewpoint.
Right.
An income-generating loan pays for itself, whereas a wedding loan is purely consumptive. But you really have to view this through the lens of local reality. What happens if the cooperative flat-out refuses that wedding loan?
Well, given the cultural weight of social obligations, I assume the family's going to host the wedding anyway. The social pressure demands it.
Exactly. And how do they pay for it if the cooperative turns them away?
They borrow it from someone else.
They go to the shadow economy. They visit predatory loan sharks who charge exorbitant, crippling interest rates. A family could lose their land or be trapped in generational debt over a single cultural obligation.
Oh, wow. I didn't think about that.
Yeah. The cooperative understands that social survival is just as important as economic survival in these communities. By formalizing that debt and keeping these non-income generating loans capped and manageable, the cooperative is essentially performing harm reduction.
They keep the member out of the hands of predators.
Precisely. They protect their long-term financial health.
That completely reframes the intent. It's a holistic view of financial well-being that recognizes cultural obligations as mandatory expenses.
It really is.
And the way they secure these loans is equally localized, isn't it? Without a credit bureau, collateral has to be tangible and immediate.
Yeah, the directive allows a borrower to pledge a rural land holding certificate or their own mandatory savings.
But the most striking option is pledging the fixed salary of a friend. And that guarantor doesn't even need to be a member of the cooperative.
That is the literal definition of community as collateral.
It's intense.
When a friend signs on as a guarantor using their salary, they are staking their livelihood on your character. It replaces the distant institutional threat of a ruined credit score with the immediate, visceral social pressure of ruining your friend's life.
Because if you default, your neighbor literally can't feed their family.
Exactly. That is a far stronger incentive to repay a loan than an arbitrary number dropping on a credit report.
The directive also leverages this dynamic through group loans, right?
Yes.
Two or more individuals can take joint liability for a single business plan. So if one person struggles with their portion of the business, the other members have a direct vested financial interest in stepping in to help them succeed.
Because the entire group is on the hook for the debt.
It weaponizes community solidarity to ensure financial stability.
It does. But that level of intertwined community risk brings up a pretty glaring vulnerability.
What happens when an external shock hits?
Right. If you, the listener, are guaranteeing your neighbor's loan and your other neighbor is guaranteeing yours, the network is incredibly tight. But if a localized disaster strikes, how does the community avoid a domino effect where one default triggers a chain reaction of bankruptcy?
And this exact vulnerability is addressed in the directive's framework for microinsurance.
Yes, exactly.
Because you really can't have community-backed lending without a community safety net. The directive introduces standard microinsurance alongside takaful tauni.
Which is a cooperative insurance model based on Islamic principles.
Right. And the foundational rule for this insurance is that it is strictly nonprofit.
Its sole function is to cover actual verifiable losses and protect the cooperative from mass loan defaults.
So how does it work in practice?
Well, members pay premiums, or in the case of Takaful, they make a tabaru.
A tabaru?
Yeah, which is a donation-based contribution to a mutual fund.
Yeah.
The underlying psychology here is mutual aid. You contribute to the pool to protect your neighbors with the legally binding assurance that they are doing the exact same for you.
So it's essentially a legally binding community GoFundMe.
That's actually a pretty good analogy.
It's a safety net. But the genius of this microinsurance isn't just in what it covers, but in what the directive explicitly excludes.
Oh, the exclusions are fascinating.
The list of exclusions tells you everything you need to know about the scale of this operation. It strictly does not cover natural disasters, so no droughts, no floods, no earthquakes, no epidemics.
Right.
It excludes human-made disasters like war or ethnic conflicts. It voids coverage for suicide or fraud. And it features a very specific, almost cinematic clause.
Yes, I know the one you mean.
It explicitly states it will not cover injuries sustained while a member is trying to escape after committing a crime.
Which paints quite a picture, right?
Yeah.
Someone twisting an ankle while fleeing a scene.
It's not a trampoline for bad behavior. If you break the law and twist your ankle running away, the cooperative is not paying your medical bills.
Exactly. But jokes aside, the broader list of exclusions is actually a masterclass in institutional survival.
Because if a local cooperative tried to offer drought insurance to a farming community, and a drought actually hit,
100% of their members would file a maximum claim on the exact same day.
and the cooperative would be insolvent by noon.
Absolutely. A drought or a war is a systemic risk. A small, geographically concentrated cooperative simply doesn't have the deep capital reserves required to absorb a systemic shock.
That requires national or international reinsurance.
Exactly. This microinsurance is strictly engineered for idiosyncratic individual risks. It's designed to step in when a single-member shop catches fire, or one individual faces a medical emergency, or an isolated accident threatens to derail a single family's finances.
Right.
By legally walling off those systemic risks, the directive ensures the safety net remains intact for the everyday tragedies it can actually afford to fix.
Which makes perfect sense. And this highly specific communal approach to risk, where they share the burden of everyday realities but refuse to engage in abstract, unmanageable bets, it naturally paves the way for the final and I think most philosophically distinct section of the entire directive.
The Sharia window.
Yes, the Sharia window, where the Cooperative Commission essentially rethinks the fundamental nature of money itself.
Right. The directive mandates that cooperatives can establish strict, Sharia-compliant, interest-free financial services operating parallel to their traditional systems.
And this is known in the industry as a window model, right?
Exactly. And it requires rigorous oversight. The directive establishes a Sharia advisory board composed of 3 to 5 independent experts to ensure absolute compliance.
And they have to keep the money separate.
Yes. It dictates that funds for these interest-free services must be mathematically and physically separated from any interest-bearing accounts.
The structural separation makes sense, but the core economic principle behind it is what really demands attention here. In this framework, money has no intrinsic value.
Right. It is merely a medium of exchange, a way to measure the value of other things.
Therefore, money cannot be sold, cannot be rented out, and it absolutely cannot grow in value simply by sitting in an account, over time.
And if you accept that premise that money cannot legally generate more money, it completely breaks the traditional banking model.
Because you can't charge interest.
Exactly. So the directive outlines 4 specific financial products that allow the cooperative to generate profit through tangible assets, real-world trade, and shared risk.
Let's examine the operational friction of these products because it's fascinating. Starting with Mirabaha.
Okay, Mirabaha.
This is essentially cost-plus financing. If a member needs a commercial refrigerator for their shop, a traditional bank just hands them cash, charges a 10% interest rate, and the member goes shopping.
Right.
But under Mirabaha, the cooperative actually has to go out, purchase the refrigerator, take ownership of it, and then sell it to the member at a disclosed, pre-agreed markup, which the member pays in installments. Wait, so instead of just handing someone cash and saying, pay me back with interest, the cooperative actually has to become a merchant. They go out, buy the refrigerator, and bring it to the member.
Exactly. And the friction here is intentional. To avoid interest, the cooperative is forced to take on inventory risk.
But does that mean the cooperative needs a giant warehouse?
It's a great operational question. They typically avoid holding massive inventory by using just-in-time purchasing.
Okay.
The member identifies the exact refrigerator they want, the cooperative buys it, and immediately executes the sale to the member. However, for that brief window of time, the cooperative holds the title. If the refrigerator is destroyed in transit before it reaches the member, the cooperative bears that loss. Profit is justified because the cooperative assumes the actual risk of trade and ownership rather than just passively renting out cash.
Wow, that completely changes the dynamic of the transaction.
It really does.
Okay, the second product is Salam, which the directive positions as forward financing.
Okay.
That's heavily utilized in agriculture, right?
Yes. Salam is a forward contract designed to inject liquidity into farming without debt.
How does that work?
The cooperative pays the farmer upfront, in cash, for a specific quantity and quality of next season's crops to be delivered on a set date. The farmer uses that capital today to buy seeds, fertilizer, and equipment.
Okay.
Then, when the harvest arrives, the farmer delivers the crop, and the cooperative sells it on the open market to realize their profit.
But this introduces a massive variable, which is the weather. What happens if the rains fail and the crop dies? The farmer has already spent the cooperative's money, but has no crop to deliver.
That is the inherent risk of Salam.
Mm-hmm.
And it's exactly why the cooperative must have deep agricultural expertise.
Right.
If a drought wipes out the yield, assuming it's a localized failure and not the systemic collapse excluded by the insurance we discussed, the cooperative absorbs the friction. Yeah. They may agree to roll the delivery over to the next season, but the core tenet remains. The cooperative is actively participating in the risk of the agricultural cycle, not just demanding a fixed interest payment regardless of the harvest.
They are invested in the reality of the farm.
Exactly.
Okay, so the third product, Ijara, handles physical equipment. It functions similarly to a lease-to-own model. The cooperative purchases an asset, say a heavy-duty tractor, and leases it to the member.
Right. And the distinction in Ijara lies in the separation of risk. During the lease period, the cooperative retains ownership.
So if the tractor breaks?
Well, if the tractor's engine block cracks due to a fundamental manufacturing defect, the cooperative, as the owner, is responsible for that capital loss.
Wow.
The member is only responsible for the operational risks, like routine maintenance and fuel. Only once all lease terms are fulfilled does ownership transfer to the member.
Okay, but the final product, Musharaka, is the one that completely subverts the traditional lender-borrower relationship.
Yes, Musharaka is amazing.
The directive defines Musharaka as a true partnership. The cooperative and the member pool their capital and labor into a joint business venture, and they agree to share both the profits and the losses.
This addresses the ultimate misalignment of incentives in modern finance. I mean, in a traditional loan, a bank does not care if your small business becomes a global empire or barely scrapes by, as long as you make your fixed monthly payment.
Right.
And if your business completely fails, the bank seizes your collateral, sells your assets, and leaves you with nothing, effectively shielding themselves from the failure of the enterprise.
Under Musharaka, that dynamic is completely shattered.
Entirely.
The cooperative provides capital as an equity partner. If the business thrives, the cooperative shares in the upside based on a pre-agreed ratio. But if the business fails, the cooperative must absorb the financial loss in direct proportion to their capital investment.
Exactly. They cannot simply seize the member's home to make themselves whole.
Which forces the financial institution to be incredibly diligent. They aren't just checking a credit score anymore.
No, they're rigorously analyzing your business plan, the market conditions, and your expertise. Because if you go down, they go down with you.
That's incredible.
It aligns the financial health of the cooperative perfectly with the success of the individual member. They're incentivized to offer mentorship, resources, and support, acting as a true partner rather than an extracted entity.
So synthesizing all of this, what does a document from the Ethiopian Cooperative Commission mean for you, the listener, navigating your own financial life?
Yeah, what's the takeaway here?
I think this directive isn't just a list of banking rules, it's a masterclass in human-centric finance. Whether it's converting a farmer's raw harvest into recognized capital, or formally funding a wedding to keep a family safe from shadow lenders, or legally requiring a financial institution to share the painful reality of a business failure.
It's all connected.
Right. This system dictates that finance must serve the lived reality of the community, not the other way around.
It proves that a financial system can be highly regulated, strictly audited, and mathematically solvent while still retaining empathy, flexibility, and cultural awareness.
Yeah.
It completely rejects the premise that banking has to be this cold, distant extraction of wealth.
Which brings us back to that X-ray machine we talked about at the start. Traditional banking relies on the rigid, binary read. It requires human lives to be static. But human lives are messy, dynamic, and unpredictable.
Very messy.
The framework we've explored today is built to absorb and support that messiness. And I want to leave you with a challenging idea to ponder.
Okay.
Think about your own bank. If traditional Western banks were forced to adopt the Musharaka model, meaning if your small business failed, the bank had to absorb a share of that failure. Instead of just seizing your house, how differently would they treat you when you walked in the door? Would they be lenders, or would they finally be partners?
That's a great question.
Thank you for joining us on this deep dive into the source material. Until next time.